In Australia, we have a self-assessment system of tax returns. Basically, what this means is that it is up to the taxpayers to fill in their tax return or have someone else, typically a tax agent, fill it in on their behalf. In most cases, the tax office will accept what is in the tax return as correct and will issue an assessment which states the taxpayer's income tax liability for the financial year. The tax return was traditionally a form that was filled in on paper and then sent to the tax office. It would contain information regarding the taxpayer's income, deductions and other relevant data for the financial year. However, for individuals, paper-based returns are now uncommon and most people lodge their return online through the tax office's e-tax system. Individuals that lodge a tax return have to do so by October 31. However, if they use a tax agent, then the tax agent will have different deadlines, meaning that it can be typically lodged after this date. For individual taxpayers, the self-assessment system is a partial self-assessment system. This means that in most, but not all cases, the tax office will issue an assessment based on what is in the tax return. So if the tax return's figures indicate that an individual has assessable income of $70,000 and deductions of $6,000, then that is what the assessment will be based on. Sometimes, however, for such taxpayers, the tax office will conduct an audit or review before the assessment is issued. And if it finds that the tax return was inaccurate, it can calculate the assessment based on its findings. However, in practice, it is not common for a review or audit to be conducted at this stage. Rather, if one is conducted, it is usually done so after the initial assessment has been issued. For superannuation funds, companies and some other types of taxpayers, the self-assessment system is a full assessment system. This means that the initial assessment will be automatically based on what is in the tax return, and the tax office will not substitute its own figures. In the case of all types of taxpayers, after the initial assessment has been issued, the tax office can issue an amended assessment. So for instance, if an individual or company has lodged a tax return and the tax office issues an assessment based on this, it can later on conduct a review or audit. If this review or audit finds that the tax return was inaccurate, the tax office can issue an amended assessment with a different tax liability. There are time limits in which the tax office can issue an amended assessment. For most individual taxpayers and businesses with an aggregate annual turnover of under $2 million, this is 2 years from the time the original assessment was issued. For larger companies and individuals with complex tax affairs, this deadline is 4 years from the time of the original assessment. However, in some instances, there are no time limits as to when the tax office can issue an amended assessment. This will most commonly be the case when the taxpayer has avoided tax due to fraud or evasion.